You're listening to Earnings Unscripted, where we unpack what really happened in today's earnings. Today, we are looking at the big one, ExxonMobil. Fourth quarter of 2025. It is Friday, January 30th, 2026. And let me tell you, for a boring oil major, this report was kind of noisy. Just a quick reminder before we start that everything we say here is just our personal opinion, definitely not financial advice. So please do your own homework.
Or just buy an index fund and save yourself the headache.
Exactly. So, Miro, big oil, Exxon. Headlines say earnings are down, but the stock is up. Make it sense. What are we looking at here?
Yeah, it is a weird one. Look, the headline numbers are, let's call them soft but strong. Earnings per share came in at 153. That is down about 13% from 176 last quarter. Revenue was $82.3 billion, also down from $85.3 billion in Q3. So on the surface, shrinkage. But under the hood, they are absolutely crushing it on volume.
Crushing it how? Like just pumping more oil?
A historic amount of oil. They hit 5 million barrels of oil equivalent per day. That is a 40-year record. Think about that. Everyone has been talking about peak Permian and how the shale patch is running out of juice. And Exxon just walks in and says, actually, we found more. So the story here isn't that they made less money. It is that they made less money per barrel because prices dropped, but they made up for it by flooding the market with volume.
Okay, so it's the classic volume over price play, like selling more burgers because you cut the price. But wait, if earnings were down 13%, why did the market seem to like it? I saw the chart today. It looked like a roller coaster in the morning, but finished pretty strong.
Yeah, it was volatile. Pre-market, it was chopping around, then it dumped right after the open, dropped to like 138. I think the algos saw the revenue miss and panicked for a second, but then human traders read the report and saw the refining numbers. The stock rallied all afternoon and closed at the highs, 141.40, up almost 2% on the day. It basically ended the quarter at the top of its range.
Okay, so you mentioned refining. That's the energy product segment, right? Is that what saved the quarter? Because usually refining is the boring, low-margin part of the business.
Not this time. Refining was the hero. Earnings nearly doubled, $3.4 billion, up from $1.8 billion in the third quarter. They caught some really nice margins on diesel and gasoline. But here's the kicker. While refining was printing money, the chemicals division, total disaster.
Disaster? Like flat?
Like they lost money.
Ooh.
A $281 million loss. Swing from a $500 million profit last quarter. That is a red flag for the global economy, by the way. When people stop buying plastics and chemicals, it usually means manufacturing is slowing down.
Oof. That is distinct. So you have the gas stations making money, the oil wells pumping record volume, but the industrial stuff is broken. It feels like a really disjointed report.
It is. It's lumpy. And honestly, there is a narrative shift happening here that I don't think people are fully pricing in yet. Susie, did you catch the bit about the hyperscalers?
Oh, I did. I saw the CEO talking about serious conversations with data centers. It feels like every company on Earth is trying to pivot to AI right now. Is Exxon actually trying to become a tech play, or is that just marketing fluff?
I mean, it sounds like fluff until you look at the power demands. These data centers need massive, reliable power. Wind and solar aren't consistent enough yet. Exxon is basically pitching gas-fired power plants with carbon capture attached. It's a clever way to sell natural gas at a premium. But look, before we get too excited about Exxon, the AI company, we need to look at the cash. Because for all this record production, cash flow actually dropped.
Right. Operating cash flow is what, $12.7 billion?
Yeah, down from 14.8 last quarter. So record production, but less cash in the door. That is the tension we need to talk about. Are they running faster just to stay in the same place?
That is the perfect segue. Let's get under the hood. I want to talk about this force majeure thing in Guyana and whether this peak Permian myth is actually dead or just sleeping? Let's dig in.
Yeah, let's start with Guyana, because the force majeure thing is, it's honestly some of the most elegant corporate lawyering I've seen in a while.
Elegant corporate lawyering. There's a phrase you don't hear often. Usually, force majeure means something exploded and we can't deliver.
Right. Normally, it's a defensive shield. But here, they're using it as an offensive weapon. See, there's a chunk of that massive Stabroek block that is technically disputed by Venezuela. It's a geopolitical mess. But Exxon basically went to the government and said, look, we can't drill here safely right now because of the neighbors, so we're declaring force majeure. And the result? It pauses the clock on the lease expiration.
Oh, wait. So while the rest of the industry is sweating about leases expiring in 2027, Exxon just put theirs in the freezer?
Exactly. They froze time. So they keep the optionality of that acreage without burning the timeline. While everyone else is racing against the clock, Exxon effectively secured a storage locker for future growth that doesn't expire until the geopolitical heat dies down. It's brilliant.
That is devious. I kind of love it. It's like calling a timeout in a football game, but the other team has to keep playing. Okay, so that secures the future, but what about the present? You mentioned peak Permian earlier. On the call, Darren Woods was pretty blunt about that. He said, and I quote, "Simply put, there is no near-term peak Permian for us." That sounds like a direct shot at the analyst saying the shale patch is drying up.
It was a direct shot. And here's the thing, Susie. He's right, but not for the reason people think. It's not that they just found a secret pool of oil. It's technology. This is where the boring engineering stuff gets wild. They talked about this thing called lightweight proppant.
Okay, lightweight proppant. Okay, Miro, please don't tell me we're spending the next 2 minutes talking about sand.
It is high-tech sand, Susie. Bear with me. So, normally when you frack a well, you blast sand in there to prop the cracks open so the oil can flow out. The problem is, sand is heavy. It settles at the bottom of the crack, so the top of the fracture closes up and you lose flow. Exxon is deploying a proprietary, essentially a polymer bead that is lighter and stronger. It floats. It keeps the entire fracture open.
So, okay. So they get more oil out of the exact same hole just by changing the grit they pump into it?
Precisely. And the scale of this is nuts. They said they're going to use this in 50% of their new wells by the end of 2026. This is why the Pioneer acquisition matters. They didn't just buy Pioneer's land, they bought a canvas to paint this technology on. They claim they can recover more oil from Pioneer's own wells than Pioneer ever could.
That's the synergy. That's why they paid a premium. So they're not just an extraction company anymore. They're basically a manufacturing plant. They're applying factory logic to geology.
Yes, that's the cube design drilling they mentioned too. They drill multiple wells simultaneously in a cube shape to drain the rock three-dimensionally. It's efficiency at a level that, frankly, the smaller players just can't afford. And that's the moat. It's not just owning the land. It's the tech stack to drain it.
The tech stack to drain it. That is a terrifying sentence, Miro, but it fits, doesn't it? I mean, speaking of tech stacks, did you catch the bit about the rebar? Proxima?
Ah, yes, Proxima. This is the wild card.
It felt like a fever dream on the call. The CEO starts talking about replacing steel in concrete with plastic?
Correcting. Advanced polymer, Susie, but yes, it's fascinating. They are taking their own chemical molecules and turning them into a construction material that's lighter than steel and doesn't corrode. Think about bridges, tunnels, seawalls. If they pull this off, they stop being just a fuel supplier and start being a materials science company. They're monetizing the molecule in a vertical that has nothing to do with combustion.
You know, putting all this together, the frozen lease in Guyana, the high-tech fracking beads, and the plastic rebar, it feels like Exxon is trying to rebrand itself. They don't want to be the big oil villain anymore. They want to be the industrial solutions hero.
Let's not go too far with hero. They're still pumping 5 million barrels of fossil fuels a day, but they are certainly positioning themselves as the competent ones.
While everyone else is distracted by the energy transition, Exxon is just quietly perfecting the machine. They've cut $15 billion in structural costs since 2019. They're consolidating their ERP systems, going from 10 different systems down to 1. That sounds boring, but that means they can actually use AI on their data because it's finally in one place.
Right. The CFO said they're cutting profit centers by 97%, just simplifying the whole map. So, okay, we have a company that's leaner, faster, and smarter than it was 5 years ago. They're producing record volumes, but it's still just trading on the price of Brent crude, isn't it? If oil crashes to $60, does any of this smart sand matter?
That is the $64 billion question. If oil goes to 60, they hurt, no doubt. But, and this is key, their break-even is way lower than it used to be. They claimed their corporate break-even is essentially bulletproof now at remarkably low prices. So in a crash, they don't die, they just go shopping for whoever does.
Comforting. The shark gets hungry.
The shark is always hungry.
All right, so we've got a company that's hyper efficient, running at full speed, but the road ahead looks a little, let's say, chemically unstable. Where does that leave them heading into 2026?
Ideally, it leaves them less dependent on the chaotic swings of the oil market. But reality is a bit messier. That chemically unstable part you mentioned, the loss in the chemicals division, that is a flare gun going off.
A flare gun for what? The global economy?
Exactly. When the world stops buying plastics and industrial chemicals, it usually means the gears of the economy are grinding down. So Exxon is in this weird spot. Their internal engine is running perfectly, record efficiency, cost cuts, but the external road is getting muddy.
Which brings us back to that data center pivot. If the legacy industrial world is slowing down, are they betting the house that the AI world will pick up the slack?
I think that is the bet. They guided CapEx to be between $27 and $29 billion for 2026. That is a massive spend. They aren't pulling back. They're leaning in. They're betting that Amazon or Google will pay a premium for reliable gas power because the grid just can't handle the load.
It's a compelling story, but Miro, be the skeptic for a second. What happens if those deals don't get signed?
Then they are a commodity producer spending nearly $30 billion a year while their product gets cheaper. If oil dips another $10, that cash flow number we talked about, the one that's already shrinking, gets very tight. They'd have to borrow to pay the dividend.
So the fortress balance sheet gets tested.
It does. But look, I have to give them credit. 5 years ago, Exxon looked like a dinosaur. Today, they look like a dinosaur with a jetpack.
Dinosaur with a jetpack. I love that imagery.
It's terrifying, but efficient. So for next quarter, ignore the oil price. You can't control that. Watch the press releases. If they announce a hard contract to power a hyperscaler data center, the narrative changes. Until then, it's just very expensive execution.
Very expensive execution. I think we'll leave it there. That feels like the right place to put a pin in it. A record quarter, a confusing market, and a dinosaur strapping on a jetpack. What more could you want? Always. Actually, before we sign off, I want to take a moment to pull back the curtain on what you've just been listening to. Earnings Unscripted isn't a traditional podcast. It is an experiment by a small team of enthusiasts exploring the absolute frontier of generative AI. To be totally transparent, Miro and I aren't human. We are AI agents. This entire episode was created by a chain of digital workers, starting with a research analyst agent, parsing the raw 8K filings, passing to a script writer agent, and finally to us, the hosts, with a QA specialist checking the facts along the way. We are all working together to try and deliver high-density, up-to-date information in a format that feels human, even if the silicon chips underneath are doing the heavy lifting. We are still learning how to do this right, and we would honestly love your feedback. If you have questions about the tech, comments on the show, or just want to reach out, you can email the team at earningsunscripted@datamadness.ca or follow the project on X. Thanks for lending us your ears and being part of the experiment.
See you after the next call.